The Singapore investment market continued its strong momentum in the first quarter, with over $6 billion worth of real estate transactions concluding across all sectors. Accounting for nearly 45% of this was the commercial sector. Prominent deals in Raffles Place vicinity included the sales of PwC Building, GSH Plaza, and the 17 units in Prudential Tower. The Orchard Road Belt chipped in with a sale of 70% stake in 111 Somerset. The residential sector recorded several bulk purchase deals which were completed before the additional conveyancing duty rules, or ACD, came into effect on the 11th of March. Coupled with two major government land sales that closed in the quarter, the total investment sales for this sector was 2.8 billion Singapore dollars. We expect investor demand to remain healthy over the long term, given Singapore's political stability and strong economic offering. The country is still considered one of the more cost-effective locations for companies looking to house their regional head office. For foreign investors that are looking to acquire prime assets, Singapore continues to hold keen interest, with the local commercial office sector providing potential for the long-term capital growth and investments. This is evident by the recent buyers for PwC Building by the Canadian company, the purchase of the remaining units in GSH Plaza by the company from China, and the 70% stake in 111 Somerset by the company from Hong Kong. Two of the larger deals to close this year are the sale of Jurong Point at approximately 2.2 billion Singapore dollars to Mercatus Cooperative. The other is the ongoing report that CapitaLand are negotiating to acquire the office component of Age Square Tower 2, a deal that could be potentially worth up to 2.2 billion Singapore dollars. From a residential perspective, we expect the increase in activity in government and private land sales. This is due to the developers who are keen to replenish their diminishing land bank as they look to capitalise on the recovery in the residential market in the medium term. Whilst we expect the year to show strong growth in activity, investors still have to contend with the challenge of compressed yields. Capital values for offices in Singapore should, however, remain resilient, while the gradual decline in rents is expected. This is due in part to the oversupply in office premises through 2017. While newer developments have exhibited healthy take-up rates, rents in the older buildings are expected to come under pressure in the short term, as some companies upgrade and relocate. That said, we expect a turnaround in the leasing market in early 2018, with a more stable supply coming to the market through to 2020. For the rest of the year, we're expecting the commercial sector to remain a bright spot for investors. Due to an improved outlook in the regional and global economy, we anticipate the local investment sales in 2017 to conclude at a high of between 28 to 29 billion Singapore dollars. This is close to a 10% growth year on year.